The first 100k is brutal, but after that it gets way easier. That quote came from billionaire investor Charlie Munger, and it's one of the most important ideas in personal finance. This principle is more than just vague motivational rubbish, it's rooted in math, psychology, and human behaviour. In this video, we'll look at the real reasons behind it, explore the mental and financial barriers involved, and explain how compound interest and momentum turn the tide after that milestone. Please do subscribe if you haven't already, it really helps this small channel grow. When you begin your financial journey, you're not just fighting economic forces out of your control, you're battling yourself. The early stages of wealth building often come with a low income if you're early in your career, student or consumer debt, limited financial literacy, low savings rates and lifestyle inflation or peer pressure to spend. At this stage, you often don't yet have the habits, systems or confidence to build wealth efficiently. Every $10 saved feels like a drop in the ocean. Worse still, because your net worth is small, any gains from investing are negligible. A 10% return on $1,000 is only $100. That's not life-changing money by any means, and hardly feels worth the effort, especially when compared to things like rising rent or mortgage payments, fuel prices, and social expectations to spend on things you don't necessarily need. Think financed cars or designer clothes. When you start out investing, you're working against a wall of mental resistance, and this reward feels far away. This makes financial discipline difficult to stick with. As we've mentioned, small capital means tiny returns. Compound interest is your best friend, but in the beginning it's barely noticeable. If, for example, you save $10,000 and earn 7% on it annually, after 1 year you've earned $700 in returns. But if you had $100,000 invested at the same 7%, you'd earn $7,000 in that same year. 10 times more without working any harder or longer. This shows us a brutal truth. In the beginning, your savings rate matters more than your investment returns. That's hard because it means your progress depends almost entirely on how much you can scrape together, not on how smart you invest. Once your investment base is larger, the magic of compounding begins to take over. Until then, it's all hard work from you to build your portfolio and returns. Everyone has fixed costs: rent, mortgage, bills, food and transportation, just to name a few. Those hit much harder when you're just starting out. If you earn $1,800 a month and your rent is $800, that's 44% of your income. But if you earn $5,000 a month and still pay $800 in rent, it's only 16%. This math is obvious but psychologically powerful. When you're starting from scratch, fixed costs feel like a real setback. You have less room to invest, save, or take risks. Even if you live frugally, the gains are small. Once you reach 6 figures in wealth, your money starts working harder than you do. You begin to break out of survival mode, and your wealth begins to build itself a bit more. Wealth building is a skill set that includes delayed gratification, budgeting, investing literacy, automation, and avoiding emotional decisions. When you're working toward your first 100k, you're learning these skills through trial and error. You might make mistakes such as bad investments or overspend, but these errors are educational. This foundational period is like compounding itself, slow at first but with an unlimited payoff. By the time you hit 100k, you're no longer just saving money, you've built an automated, disciplined, mentally bulletproof system. You know how to budget with purpose, track net worth, invest regularly, often via the dollar cost averaging method, which I've covered in a previous video. You also know how to avoid get-rich-quick traps and delay gratification. These habits alone are worth more than any single financial figure, and they're the tools that make the second 100k far easier. We've touched on compound interest earlier, but let's go into more depth. We're going to compare the starting capital and the return an investor would make after 10 years at a 7% return per year. This table assumes they hadn't invested another penny after investing their starting capital. If you started with $1,000, your 10-year gain would be $967. Starting with $10,000, your 10-year gain is $9,671. If you started with 100k, you'd expect a return of $96,715 over 10 years. Starting with 250k, you'd get a return of around $241,000. And with $500,000, you'd expect a return of just under $500,000 at $483,574. As we can see, the results are staggering. As your capital grows, the gains become massive, and all without increasing your effort. No matter how much you start with, over 10 years at 7%, you nearly double your starting capital. At 100k, that 7% is $7,000. The compound interest effect becomes real, motivating you to keep going. By contrast, in the early days, your portfolio returns feel irrelevant because the base is too small. Benjamin Franklin summed up this effect when he said money makes money, and that money makes money. Once you reach 100k, your returns start to feel meaningful, and the math finally starts working for you, not against you. Wealth building has a snowball effect. In the beginning, you fight for every saved dollar. Progress feels painfully slow and results are barely visible. But after you hit a crucial milestone like 100k, your investments not only generate decent annual gains, but you have more options like taking risks or starting businesses. Not only this, but as several years have likely passed, your income is probably higher due to career growth and you've built momentum and motivation. The first 100k mindset becomes a psychological breakthrough as well. You've proven to yourself that your system works and the hardest part is out of the way. Once you've got a larger base of capital, you can do things that weren't previously accessible. You can invest in higher entry cost opportunities like real estate to rent out. You might also be able to negotiate better deals for things such as mortgage interest rates if you have higher capital to put down as a deposit. A lot of margin trading is only by brokers to individuals with certain portfolio values. It's worth mentioning this can be extremely risky and could set you back to square one if you're not careful, but the option is there. Having built up a 100k portfolio, you also have a buffer to do slightly risky things like change career or put money into starting a side hustle, which you wouldn't be able to risk doing when first starting out. Wealth multiplies when you can put your capital to work in smarter ways, but most of these tools are only available once you've already passed a certain financial threshold. 100k is often that threshold for a lot of people. Once you've reached it, confidence begins to replace uncertainty and doubt. When first starting out, you might have found yourself wondering, am I doing this right? Is it even worth it? Should I just spend it and enjoy life now? I only have a small amount anyway. Once you hit a milestone like your first 100k, something shifts. Your system works. You survived market dips and spikes, built consistency, and created tangible results for yourself. This gives you financial confidence and peace of mind. That confidence can cause you to make better decisions, which further fuels growth. You're less likely to panic sell, chase trends, or blow your budget. Your mind shifts from how do I save money to how do I grow and protect capital. That small psychological change has a massive financial impact. You begin to focus on tax efficiency, asset allocation, passive income, risk management, and perhaps long-term financial independence. You move from survival to strategy, and your decisions begin to reflect your long-term vision, not just short-term gains. So to summarize everything we've covered, the main reason 100k is so hard is because you have little capital, you're still learning, your gains feel invisible, and your fixed costs eat up your cash flow. But once you cross that invisible line, everything gets easier. So if you're currently on the climb, keep going. This is the hardest part. The momentum you'll unlock at 100k is not just financial, it's psychological too. And that's when the real acceleration can begin. Do you agree that the first 100k will always be the hardest for any investor, and are you currently on the grind to get there yourself? Let me know down in the comments, and please do subscribe if you've enjoyed this video, and thanks for watching.